The word expenditure simply means money which is spent. And of course, money must be spent buying something. In this case of a business, money is spent to buy goods and services to use in order to earn profit. Expenditures are classified into two types: capital and revenue expenditures. Revenue expenditures simply mean expenses. Expenses provide the business with goods and services which can only be used once. Goods can only be sold once, for example. The word capital used here is quite misleading. It does not mean that it involves the owner. Capital expenditure simply means fixed assets. You have learned fixed assets before. These assets are bought for use in the business, not for resale to earn profit. Again, the word capitalized here does not mean that it involves the owner. Capitalized means that the item concerned is not treated as an expense and transferred to the profit and loss account. It simply means that the item is treated as an asset and brought to the next year. It will then appear in the balance sheet as a fixed asset. You have learned before that fixed assets last for more than one accounting year. You have also learned the matching principle, which states that the revenue earned in each year should be matched against the expenses incurred in earning it. The revenue earned in a year minus the expenses incurred in earning it will give us the net profit of each year. The fixed asset helps to earn revenue over its useful life of, say, 5 years. The cost of the fixed asset should then be divided into 5 parts and matched against the revenues of each of the 5 years. You will learn about this in another lesson. If we were to follow the matching principle, the waste paper basket should be depreciated at 20 cents per year for 5 years. It would make our net profit very accurate, but the extra time and effort would not be worth the accuracy. A user of the financial statement would not change his decision if he were to be told that the net profit of a business is 20 cents more, or 20 cents less. The word material means important. To be important, the item must be large in relation to the size of the business. Please refer to your textbook, page 305. In this example, Roslin incurred an expenditure of $10,000 to spray his cars in the year 20x1. Next year, he expects to repaint the cars in a different color. In other words, the benefits of this $10,000 expenditure will be used only in this year 20x1. Now, the question: should the $10,000 be treated as an expense in 20x1, or added to the cost of his motor vehicles, and brought forward to the next year as part of the motor vehicles? At the moment, the $10,000 is treated as an expense in the profit and loss account. If it is capitalized, in other words, treated as fixed asset, the expenses in the profit and loss account would be lower by $10,000. The net profit then would be $5,000, instead of a net loss of $5,000. The motor vehicles in the balance sheet would then be higher by $10,000. The painting costs should not be treated as fixed asset, as the benefits of the painting would not last beyond this year 20x1. So far, we have been talking about expenditures, or the business spending money. What about the business receiving money? Receipts means the business received money. We classify receipts into two types, capital and revenue receipts. Revenue receipts means that the money comes from transactions that are recurring, or happening again and again. These refers to the activities of earning revenue. Again, the word capital here does not mean that the money must come from the owner. It means that the money comes from transactions that do not happen again and again. These are not revenue transactions. Examples of capital receipts are money obtained from loans, and yes, money from the owner is also classified as capital expenditure, as the owner does not do that every day.